Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep Rao and we are in week 20 of 2026. This week I want to start with a meme from Masan because that's exactly how I felt all through the week. The largest sentiment of the week was driven by the Prime Minister's statement about the need to be more austere, be it in terms of oil consumption or gold or foreign travel. Of course, the social media didn't take it lightly, but nevertheless, the markets got spooked. But thankfully, Wednesday and Thursday saw some recovery from the lows. The rupee fall and the duty hike was quite evident across commodities like gold and silver, so everything from precious metals to industrial metals and crude is up largely. Whether you look at the world geopolitically or India specifically in economic terms, these are indeed tough times. Let's see how we progress from here. So anyways, let's get back to our weekly market metrics and explore what happened last week and look at what could happen in the coming week. Let's start with our usual rate of change across indexes. This week, almost all the indexes we track are down anywhere between 2 to 3%, dragging the month-to-date returns for May for all indexes except MIDCPNIFTY into a negative territory. BANKNIFTY lost the most, dropping 2.89%, while Nifty managed to contain the damage the best, losing the least at minus 2.2%. True to form, MIDCPNIFTY remains the strongest of the lot when you look at it from the year-to-date standpoint, while Sensex continues to lag behind as the weakest among the all. Now let's look at Nifty across different time frames, starting with weekly. This week, Nifty lost 533 points or 2.2% to close at 23,644. As you can see on the chart, the price has slipped below both the 20 and 40-week SMAs and is hovering just slightly above the 10-week SMA. The weekly range expanded significantly to 735 points from the last week's 600 points. The 10-day daily average range currently sits at 251 points, which is close to 1%. But it feels a lot more volatile on ground because these moves are cutting sharply in both directions rather than just trending one way. In fact, Tuesday's Nifty 0DT saw the highest daily range of the week at 409 points, which I will cover shortly when I talk more about the expiry. In last week's episode, we spoke about Nifty getting stuck in a 1050 point range between 23,550 and 24,600. This week, Nifty finally broke out of that range, but on the downside, only to recover late in the week and close right back inside at 23,644. The first 2 days were brutal, with Nifty dropping 1.49% and then 1.83%. Then on Wednesday and Thursday, it made a comeback, gaining 0.14% and 1.18% before finally cooling off to close in red with a 0.19% drop on Friday. If you look closely, Nifty basically made a perfect V-shape on the daily time frame this week. Okay, so this V-shape thing was a joke, so everyone should stop looking at this VMW shape because none of that matters. Okay, back to the daily time frame. Nifty is now trading below its 2150 and 100-day EMAs as well as its 200-day SMA. With the index slipping under these major moving averages simultaneously, the charts are telling us one thing loud and clear, that Nifty is firmly in a bearish grip. On the hourly time frame, Nifty opened well below the 50 EMA on Monday's gap down and stayed under it until Thursday's strong up move. Since then, it's been chopping around back and forth around the same 50 EMA. In all of this, short-term trend followers continue to get absolutely chopped into pieces. I'm sorry if I sound like a broken record, but at this point, the only way to deal with this is proper position sizing, and there's nothing else that could keep you in the game for the long run. Talking about the Nifty weekly expiry on Tuesday, 12th of May, well, it was one of the cleanest trending days in Nifty in a long while, and it happened to be a 0DT as well. So the index moved a massive 409 points or 1.72%. Opening gap down, it never looked back and went on to close 436 points lower at 23,380. On this very day, Nifty broke the lower end of that 1000-point range at 23,555, the one we spoke about last week. Strategies that benefit from a clean trending move like the time-based straddles with fixed stop losses on individual legs or pure directional setups would have made fantastic gains that day. On the flip side, pure delta neutral or rolling straddle type strategies would have suffered significantly. Do let me know in the comments how did your expiry go. Moving on to what to expect in the coming week. Well, Nifty broke its month-long 1050-point range this week but managed to stage a recovery and close right back inside. Now currently the chart shows a clear resistance at 23,800 while the immediate support has shifted down to 23,150. Now looking at the straddle premiums to gauge the expected range for the upcoming weekly expiry on Tuesday 19th of May, the Nifty straddle closed at 315 points up from 283 points last week, implying an expected move of roughly 1.33% on either side. Now this math gives us an expected range of 23,960 on the upside and 23,330 on the downside. At this stage, in a news-driven market environment like we are right now, pricing in overnight risk, especially over the weekend, is proving to be incredibly difficult. There are weeks where a 300-point premium feels like a solid cushion, only for the index to gap down by the exact same margin right after the weekend. Whether this current straddle price is truly enough to cover the risk, I honestly don't know. We'll just have to wait and see how the index behaves heading into Tuesday's expiry. As of now, my overall bias for Nifty remains bearish with the expectation of occasional pullbacks towards 24,000. Unless we see Nifty actually clear and close about 24,600 on a daily time frame, the broader bias is going to stay firmly bearish. Looking at the directional bias of the four major indexes that we track, everything has flipped into a negative short-term and medium-term bias. The lone warrior is MIDCPNIFTY, which is stubbornly holding on to both the short-term and medium-term biases. In other words, it is the only major index where the price is still trading cleanly above its 21 and 50 period EMAs. Moving on to India VIX, well, it rose 11.59% this week to close at 18.79, largely driven by signals from the Prime Minister that the economy is under stress and that austerity measures may be on the horizon. Moving on to the performance across sectoral indexes this week. Now, if we look at the top performing TJI indexes this week, well, we had upstream, rating agencies, dyes and pigments, telecom and metals. Of these, the three worth focusing on are those closest to their 52-week highs: upstream, dyes and pigments and metals. Upstream makes a comeback after a week's pause, though on a larger basis, no other indexes are overlapping from last week's top performers. If we look at it from the perspective in terms of the indexes which are closest to the 52-week high, well, the number of indexes trading close to the highs has dropped considerably, reflecting the broader decline in market breadth. Upstream is currently the only index sitting near its 52-week high. From last week's top 10, metal pipes, asset management, metals and communication equipment are all holding their ground. Jewelry, however, has taken a hit, likely a consequence of the recent duty hike. Overall, a tepid week on the sectoral picks as well. Moving on to commodities, well, on a daily time frame, gold mini futures crossed the 50-day moving average and on Wednesday spiked up and closed at 16,1504. I guess trend followers on gold were the only happy folks this week. But I must say the joy was short-lived as Thursday and Friday witnessed a wave of profit booking with gold prices pulling back roughly 3.4% from those spectacular highs made on Wednesday. Same with silver mini. Silver crossed the 50 MA last week and made a high of approximately 3,06,664, but it also pulled back a massive 10% by Friday. But that's how silver always is. Overall, on commodities, this was one of those weeks where everything is in the green across the board. All commodities are up. Gold is up close to 4.5%, silver around 5%, copper around 1.7%, while crude has surged a massive 10% and natural gas sits at a 7% gain. What's driving this? Well, it's a combination of depreciating rupee, elevated crude oil prices, and duty hikes on precious metals. Talking about investing in commodities, well, for those who would rather avoid derivatives, there are equity proxies worth considering. For oil and gas exposure, look at the TJI Upstream Sectoral Index, and for gold and silver, the industrial metals, that is TJI Metal Index, is something worth considering. Now, obviously, these won't move in lockstep with the underlying commodities, but directionally, you would be able to capture a meaningful portion of these gains. Again, this is not for short-term players. You have to play this game on a longer term. So that's pretty much on commodities this week. Well, if I have to look at it overall, well, the markets got slammed this week as the Prime Minister's austerity speech spooked investors, dragging major indexes down 2 to 3%, wiping out all of May's gains. Nifty slipped below all major daily moving averages into a firm bearish grip. BANKNIFTY was the weakest link, while MIDCPNIFTY stubbornly remains the only positive outlier holding onto its trend. Tuesday on Nifty's expiry saw a massive downtrending day, delivering a brutal decline that cracked our month-long range. And if we talk about the midweek bounce, that wild price action completely chopped the short-term trend followers. Reflecting all this panic, India VIX jumped sharply. Meanwhile, a falling rupee and duty hike sent commodities soaring, crude spiked, and gold hit a massive record high before cooling off a bit. The bottom line, the bias remains heavily bearish. Expect clear overhead resistance and lower support levels. And with the straddle pricing in a wide expected range for Tuesday, keep your position sizing tight to survive. Moving on to what caught my attention this week, well, I've got two interesting recommendations for you. Both are great watches. In last week's meeting between Trump and Xi Jinping, or as they are calling it, the 2026 summit, Xi apparently warned Trump about a possible Thucydides trap. Now, yes, that's quite a mouthful, but that is what it is. And that reminded me of this TED talk by the person who coined the term Thucydides trap in relation to politics. That's Professor Graham Allison. Note the fact that this TED talk happened close to 8 years back, and all that you hear in it is as relevant or perhaps more relevant to what's happening right now in the context of US and China relation. My next recommendation for the week is Dave Perel's interview of Maria Popova. I've been following her blog Brain Pickings ever since it existed, and at some point it got re-christened to Marginalian, but over the years the blog has been a constant companion for me both in good and bad times. I'm really inspired by her story and her taste. I just learned that it's been made a part of a permanent archive of the Library of Congress, another great interview watch. As always, you'll find all the links in the show notes. Now over to the events to factor in for the coming week. Well, next week is a usual 5-day trading week with the FOMC meeting scheduled for 20th May, Wednesday. And that's pretty much it. And with that, we wrap up this week's weekly market metrics. If you find the series useful, don't forget to subscribe to this channel. And yes, please do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.